The financial markets operate on cycles of expansion and contraction, of liquidity feasts and famines. At the heart of the current global speculation is a single monumental pivot point: the return of quantitative easing key. My analysis synthesizing monetary policy signals, historical patterns, and forward-looking prediction markets strongly indicates that the trigger for this next great wave of liquidity will be pulled in early 2026. This isn't mere speculation. It's a forecast built on a clear mechanistic threshold deeply embedded in the Federal Reserve's own playbook. The journey to this point is a countdown governed by interest rates, and we are now in the final stages of that countdown sequence. To understand why 2026 is the focal point, we must first decode the Fed's operational trigger. Historical analysis reveals a consistent, almost mechanical pattern. Large-scale asset purchasing key programs have consistently been initiated once the federal funds rate descends and sustains itself below the 2% boundary. This isn't a casual correlation, it's a policy line in the sand. When rates are high, the Fed has ample room to stimulate the economy through conventional cuts. But once rates approach that lower bound, the so-called effective lower limit, their conventional ammunition is nearly spent. To provide further stimulus, or critically to address a market crisis or liquidity seizure, the Fed must reach for its unconventional tool. Our entire timeline, therefore, hinges on one question: how long until rates cross that 2% Rubicon? This is where the prediction markets become our most valuable crystal ball. These are not opinion polls, but real money betting platforms where traders stake capital on specific outcomes, creating a powerful aggregate of informed sentiment. The current consensus forming in these markets is unequivocal. 2026 is the year of the great cutting cycle. The bets aren't on if rates will fall, but on how many times. The probability metrics show a significant chance, well above 40%, of seeing 4 or more rate cuts in that year alone. Let's contextualize that. 4 0.25% cuts equate to a full percentage point of reduction. If we enter 2026 with rates, for argument's sake, at 3.5%, such a cycle would bring us directly to that pivotal 2.5% region, teetering on the edge of the trigger zone. A more aggressive cutting scenario, which the markets are also pricing in as a substantial possibility, would plunge us decisively below it. The implications of crossing this threshold are seismic and extend far beyond bond yields. We must conceptualize liquidity not as a passive pool, but as an active, hungry force. My core thesis is that liquidity is a predator, and it's always hunting for a home. For years, during this period of high rates and quantitative tightening, trillions of dollars have been lured into and parked in safe yield vehicles, money market funds, treasury bills, and yield-generating stablecoins like USDC and BTC have offered attractive returns with perceived low risk. This capital is inert, sidelined, and waiting. The moment the yield on these safe havens begins to compress dramatically, which is the direct and inevitable result of an aggressive Fed cutting cycle, the entire calculus changes. That parked capital becomes restless. The incentive to sit still evaporates. The predator stirs. This capital must now seek new hunting grounds to maintain returns, and history shows it floods into risk assets. It flows into equities, into credit, and, with increasing velocity, into the digital asset space. This is the fundamental engine of every bull market: the migration of capital from low-risk, low-yield environments into higher-risk, higher potential return arenas. The 2026 trigger doesn't just mean cheaper money. It means the activation of a dormant, multi-trillion-dollar force that will be compelled to move. Furthermore, this timeline is not happening in a vacuum. The Fed is acutely aware of the systemic fragility that prolonged tightening can create. We saw glimpses of this in the regional banking crises of 2023. Their mandate isn't just inflation and employment, it's also financial stability. As they guide rates down, they will be meticulously and nervously watching for stress points in the overnight lending markets, in commercial real estate, and in sovereign debt markets. The shift back to key, therefore, may not be a leisurely, pre-planned announcement. It could be a reactive policy pivot necessitated by a breaking point somewhere in the global financial architecture. The 2026 timeline is our baseline for the organic move. A market crisis could accelerate it into late 2025. In essence, the path to 2026 is a deconstruction of the Fed's last line of defense. Every rate cut is a step down the staircase toward the lower bound. The prediction markets are betting we take 4 or more of those steps in 2026. When we reach the bottom, the Fed's conventional room is gone. The trigger for key, the money printer, is not activated by a date on a calendar, but by this specific interest rate condition. We are now in the final phases of the countdown to that condition being met. The parked capital in the system is the fuel. The 2026 trigger is the ignition. What follows is a global hunt for yield and the markets that position themselves to be the most compelling home for that predatory liquidity will experience historic transformations. This is the foundational mechanism, the first and most critical domino in the coming financial reshuffle. Everything else, geopolitical accelerants, technological adoptions, regulatory decisions, will amplify or modulate a process whose core mechanism is now clearly visible in the data. While the Federal Reserve's interest rate path sets the baseline timeline, a simultaneous and profound transformation in Japan is poised to act as a powerful, nonlinear accelerant. This is not a secondary factor. It is a parallel storm system on a collision course with Western monetary policy, capable of forcing the Fed's hand and reshaping the very plumbing of global capital flows. Japan's role is dualistic. It presents both a looming crisis that could demand an urgent Fed response and a revolutionary new financial architecture that will channel unprecedented liquidity into digital asset markets. Understanding this duality is key to seeing the full picture. First, let's examine the crisis component, the pressure Japan is exerting on the fragile edifice of global sovereign debt. For decades, Japan has been the world's paramount creditor nation and a colossal buyer of U.S. Treasury bonds. This reverse carry trade has been a cornerstone of global finance. Japanese institutions borrow at near zero domestic rates, convert yen to dollars, and buy higher-yielding U.S. debt, profiting from the spread. This constant massive demand has helped artificially suppress U.S. borrowing costs and support the dollar's dominance. That entire system is now under severe, perhaps terminal, strain. The source of the strain is the violent repricing of Japan's own. After years of ultra-loose yield curve control, the Bank of Japan is finally allowing market forces to influence its bond market. The result has been a historic surge in yields. The Japanese 30-year government bond yield, which once traded at an almost unimaginable 0.2%, has rocketed above 1.5% and is testing multi-year highs. This is a seismic shift within Japan's financial system. As domestic yields rise, the incentive for Japanese banks, insurers, and pension funds to send capital abroad diminishes. More critically, it creates a dangerous feedback loop. Higher yields increase the cost of servicing Japan's own gargantuan public debt, the highest in the developed world relative to GDP. This forces the Japanese government to issue more bonds to cover interest payments, potentially flooding the market and pushing yields even higher in a self-reinforcing spiral. Here is where the crisis directly threatens U.S. policy. If Japanese institutions face a domestic liquidity crunch or need to shore up their balance sheets amidst this volatility, their logical move is to sell their massive holdings of U.S. Treasuries to raise cash. A large-scale, coordinated sell-off by one of the world's largest creditors would immediately destabilize the U.S. bond market, causing yields to spike violently and the dollar to weaken. Such an event would constitute the very definition of financial stability threat under the Fed's mandate. The Fed would be forced to intervene, not in 2026 according to a preset plan, but immediately. Their primary tool to stabilize the Treasury market. They would have to halt quantitative tightening, QT, overnight, and likely restart quantitative easing, key to act as the buyer of last resort for the bonds Japan is selling. In this scenario, Japan's internal debt crisis becomes the direct proximate cause for an early, emergency reactivation of the Fed's money printer. Simultaneously, and perhaps even more consequentially for the future of finance, Japan is not merely a passive crisis vector. It is proactively building the escape hatch in the new pipeline. This is the revolutionary component. While its traditional bond market convulses, Japan is spearheading one of the world's most advanced and integrated blockchain-based financial ecosystems. Led by consortiums involving giants like SBI and Sony, the focus is on creating a seamless, regulated digital asset infrastructure with a killer application, the yen-backed stablecoin. The strategic advantage here is profound. The Japanese yen remains one of the world's most trusted reserve currencies, and crucially, it is structurally a low borrowing rate currency. By tokenizing the yen on a blockchain, these new platforms can offer near-instant, global, and incredibly cheap access to yen-denominated liquidity. The CEO of Sony's blockchain venture put it succinctly: their ecosystem enables incredibly cheap loans. Imagine a world where a digital asset trader in Europe or a gaming studio in Southeast Asia can access a low-interest loan in a digital yen stablecoin with minimal friction, bypassing traditional correspondent banking networks entirely. This creates a powerful new carry trade for the 21st century: borrow cheap digital yen, convert it into other higher-yielding digital assets, and capture the spread. This innovation is not happening in a silo. It is being integrated. Newly licensed Japanese digital banks are forming partnerships with leading global DeFi protocols like Morpho, effectively creating sanctioned on-ramps and off-ramps between traditional Japanese finance and the decentralized digital economy. This is the construction of a stealth liquidity pipeline. It is a legally compliant corridor through which massive amounts of yen-based capital, from retail savers to institutional portfolios, can flow directly into crypto markets, seeking the yield that is disappearing from their own aging bond market. The Japanese government is supercharging this migration with policy. The planned reduction of the crypto tax from a prohibitive 55% on unrealized gains to a flat 20% is a watershed moment. This single regulatory shift will unleash a torrent of domestic capital that has been frozen on the sidelines due to punitive tax treatment. It will also make Japan a magnet for global crypto talent and investment, positioning Tokyo as a rival to traditional hubs like Singapore and Switzerland. Therefore, Japan's role is transformative. The real-world asset RUA tokenization gateways, protocols that bridge tangible assets, treasury bonds, real estate, commodities, onto the blockchain, will become magnets for traditional finance, TradFi capital seeking familiar yield in a new wrapper. This sector represents the most direct fusion of incoming traditional liquidity and the crypto infrastructure. The second pathway into high-efficiency yield generators will revolutionize the stablecoin landscape. The current model for major stablecoins like USDC is largely a spread play on high-interest rate environments. As rates fall, their revenue models compress, making them less attractive as inert holdings. The incoming liquidity will instead seek out utility-driven and algorithmic stablecoin models that generate yield through active market mechanisms like the basis trade mentioned in the script, or through integration with revenue-generating DeFi ecosystems. Stablecoins will transition from being passive dollars on-chain to being active, yield-bearing units of account within specific economic loops. This will drive value to the tokens that govern these new stablecoin systems, as their demand will be tied directly to the fee revenue they generate from facilitating capital flow. This entire migration will be supercharged by the Japanese liquidity pipeline previously discussed. The influx of cheap digital yen will not simply buy Bitcoin or Ethereum outright. It will seek the highest risk-adjusted yield within the global digital arena. This will disproportionately benefit the ecosystems and protocols that are most directly integrated with or accessible from Japanese regulatory sandboxes and partner banks. A protocol that is whitelisted or easily accessible to a Japanese digital bank's clients could experience a sudden massive inflow that is detached from Western market sentiment, creating powerful localized bull markets within the global context. Furthermore, this capital migration will expose and widen the gap between assets with clear utility and value accrual models and those without. The spray and pray approach of the 2021 retail-driven cycle will be replaced by a more targeted, institutional-style allocation. Projects will be scrutinized for cash flow, governance sustainability, and real user adoption. The narrative will shift from pure speculation on token price to ownership of productive digital infrastructure. Capital will flow to the tokens that represent a share in the fee-generating engines of the new financial system. Finally, the regulatory clarity anticipated in the U.S. and other major jurisdictions will act as the final catalyst, removing the single largest overhang for institutional deployment. Once clear rules are established, the floodgates for registered investment advisors, pension funds, and major corporations will officially open. This capital is notoriously conservative and path-dependent. It will follow the trails blazed by earlier, risk-taking capital. They will first allocate to the most liquid, safest digital assets, Bitcoin and Ethereum, and then gradually into the ETF and regulated products built around the next tier of ecosystem tokens. In conclusion, the capital migration map is a sequence of escalating commitments. It begins with foundational liquidity absorption by Ethereum and Bitcoin. It then fans out into the most robust and integrated Layer 1 ecosystems and vertical sectors, DeFi, Ruudasu. It revolutionizes the stablecoin market by favoring utility over passivity. It is amplified by specific geographic pipelines like Japan's, and it culminates in the full-scale institutional adoption that follows regulatory green lights. The stage is not being set for a simple, broad-based price pump. It is being set for a fundamental reallocation of global capital, a repositioning of portfolios to include productive digital assets, which will establish a new financial hierarchy for the decades to come. The hunt for a home will meticulously pick its destinations, and those destinations will be forever transformed by the arrival of the predator.